Hi there and welcome to a new macro video. How realistic is the prospect of a recession in the UK economy over the next 12 months or so? A recession, defined narrowly as a period of 6 months when national output declines, typically is unusual. Recently published research from the Recession Foundation found that a recession occurs on average every 10 years, reducing living standards by over £2,000 per household. Here's the technical definition of a recession: a period of at least 6 months of a fall in national output. But it's worth being aware that individual industries and sectors can be in a downturn even if the economy as a whole is still growing. Car production in Britain, for example, has dropped sharply in recent months, and the farming industry is deeply worried by the prospects of a no-deal Brexit. However, with services accounting for over 80% of UK GDP, and retail sales, especially online, holding up fairly well at the moment, Britain could still avoid a technical recession despite the contraction in measured GDP shown in the last quarter, where GDP fell by 0.2% in the second quarter of 2019. The most recent recession in the UK after the global financial crisis of 2007 to 2008 was the deepest since the Second World War. You can see from the chart here that real output fell by around 6% from peak to trough of the cycle. And the recovery has also been one of the slowest in modern times, with investment and productivity in particular lagging an upturn in national income. Here's the Bank of England's most recent projection for real GDP growth in the UK based on the underlying assumption that monetary policy interest rates stay at their current level of 0.75%. The dark green part of this chart is their central forecast, and you can see that forecast is that the UK will avoid a full-blown recession. But you can also see that there is a lot of uncertainty, and this is because of a number of internal and external factors, such as the chance of a disorderly no-deal Brexit, and also the possible contagion effects from a deepening trade war between China and the United States. Recessions are infrequent, they're not the norm, and recessions are not inevitable, as this slide suggests. South Korea and Australia, for example, have not experienced an economic downturn since the start of the new century. Argentina, Iran and Saudi Arabia, however, have a much more recent experience of recession. So what are the possible causes of a recession? Let me just focus on 2 or 3 of them for you. Might be worth pausing the video at this point to add to your notes. The key point is that there's never one single cause of an economic downturn. It's usually the result of a mix of domestic and external factors which can combine to produce, if you like, a perfect storm. Another point worth remembering is that as a macroeconomic recession, a macro downturn, is the result of millions of decisions taken by businesses and households across the country. Macro recessions often have microeconomic foundations. Could be consumers deciding to rein in their spending and save a little more, or it could be a business opting to reduce production, postpone some investment spending, and perhaps lay off some workers to control costs. Recessions are caused by both domestic and external factors. It could be an external shock, such as a recession in a trading partner. It could be the impact of a persistent trade war. Recessions can also result from a tightening of policy, perhaps higher interest rates, or an increase in taxation. Recessions also have their origins in financial markets. Perhaps a steep, unexpectedly large decline in the level of share prices or house prices, a fall in the supply of credit via a credit crunch, and more generally, of course, a decline in business and consumer confidence. So what are some of the key recession risks facing the UK at the moment? Without question, the biggest single uncertainty concerns the outcomes of the government's determination to leave the European Union at the end of October 2019. Brexit uncertainty is certainly hitting business investment, And of course, there are the wider risks from no deal, including the supply chain disruption to car making and other industries, and a fall in incomes and exports if tariffs are imposed by the European Union. But there are also some wider concerns, including the trade dispute between two of the world's largest economies, China and the United States, and also the impact of a weaker pound causing import prices to go up and real incomes to go down. China and the United States have just begun imposing additional tariffs on each other's goods in the latest escalation of their fairly bruising trade war that sent shockwaves throughout the world economy. Just recently, in September, the new round of tariffs includes Beijing's import tariff of 5% on US crude oil. The Trump administration is going to be collecting 15% tariffs on Chinese goods ranging from smart speakers, Bluetooth headphones, and many types of footwear. This chain of reasoning is just a way of explaining how a worsening, for example, of confidence, a worsening of animal spirits among both businesses and consumers can feed through to the wider economy and potentially cause a recession. Key thing from this chart is expectations drive behaviour, and a fall, a weakening of confidence can be self-reinforcing, particularly if people cut back on their spending and decide to increase their precautionary savings. The economy, they can very quickly lose momentum. So a fall in business confidence can feed through production, to employment, to incomes, to savings, to spending. And then there are second round wider effects as businesses outside the immediate hit are then affected. So let's take a quick look at some of the latest macro indicators and what they might be telling us about the risks of recession over the next year or so. Well, declining consumer confidence is one of the big issues at the moment. Here's a headline from The Guardian. Typically when people have less confidence, they cut back on their spending and they tend to increase their savings. There are signs in this chart here, for example, that the growth of consumer credit is beginning to slow down, including those expensive loans used to buy new cars. Business confidence is taking a hit, and the car industry in particular is contracting. UK car production was down more than 10% year on year in July, and car output in the UK has now fallen for 14 consecutive months. Lower business confidence cuts planned investment and can lead to job losses as firms look to control their operating costs, and there are signs that business confidence is declining. If you look at survey evidence of output growth, that suggests that the UK GDP growth is slowing down in the UK, but also in other G7 countries. However, the chart here shows that UK output survey data is towards the lower end of the range shown, and that implies that a steeper contraction in output from industries such as construction and car making might be expected in the UK. A no-deal Brexit is affecting the housing market. It's clearly slowing down. House prices declined, or for forecast is saying that a no-deal Brexit could cause house prices to decline by more than 5% in 2020, according to new research from accountants KPMG. On the flip side, the labour market remains fairly strong. Unemployment is at 3.8%, a 45-year low, and there are just over 800,000 job vacancies, plenty of jobs available for people. However, some signs, just initial signs of a downturn in the number of job vacancies available. Well, recessions are not inevitable. There are policy options available to both government and central banks to try to mitigate, to try to reduce the risk of recession. Here are 4 examples. First of all, the Bank of England could, in theory, cut interest rates from 0.75% or could expand QE to stimulate the monetary side of the economy. The government can increase their own spending, perhaps cut selective taxes, some people suggesting that the government might cut VAT to try and stimulate the economy through fiscal policy. And in theory, a weaker pound against the dollar and the euro and other major currencies provides a lift to export sales and output, although it of course also increases import prices. And if real wages start going up, if wages start rising faster than inflation and unemployment remains low, then there's more money feeding into the circular flow from people who have a job. So recessions are not inevitable. The Bank of England is being urged to cut interest rates ahead of a possible no-deal Brexit. That will be a monetary policy stimulus. Quickly on no deal. No deal is when the agreement with the European Union is not ratified and Britain leaves the European Union without a withdrawal agreement, without a settlement, if you like. That means there's no transition period and the political declaration on a future trading relationship will not apply. Britain then reverts to World Trade Organization terms of trade, which typically involve quite high tariffs on UK products. And of course there's the prospect of a hard border between the UK and other European Union countries. I've said here that Brexit is the biggest single risk to the UK. Here's a forecast from the National Institute on the UK economic outlook and assumptions about the type of exit, the timing and the eventual policy responses determine what happens to GDP. In all scenarios, GDP is slower or lower than it would have been had there not been a deal confirmed. Monetary accommodation in this chart is the assumption that the Bank of England responds to a no-deal exit by bringing in a fresh monetary stimulus, either by cutting interest rates towards 0% or by expanding quantitative easing. My last slide really is to remind you that this whole debate, it's a momentous time we're living in politically as well as economically. This whole context has changed so quickly. Back in 2015 and a little bit beyond, surveys of opinion by Ipsos Mori suggest that Europe was only the most important issue for perhaps 2 or 3% of the population. And you can see that that's changed fundamentally, both before and during the referendum. And it's now, well, significantly the most important issue facing the electorate at the moment. Politics can change dramatically. For many, many years, European Union was not the dominant issue in UK politics. Worth reminding that sense of political context. So there we go, a look at some of the factors that can cause recession with particular reference to the UK as we head towards the end of 2019. Thank you.